Investors are piling into emerging markets right now. $1.1 billion a day of new net money has been going into emerging markets and bonds. Does this mean that emerging markets are going to be the next best investment to make moving forward? Firstly, in investment terms, the emerging markets are a collection of markets with the potential for higher economic growth. Those countries that are growing rapidly and industrializing. These include the likes of China, South Korea, Brazil, India, Taiwan, and others, but China is the largest one of them all. Over the last 1 year and even 5-year period, the emerging markets have had a much tougher time than the US market. Let's just take a look at 2 different ETFs that show us this. Here we are looking at Vanguard's Emerging Market Stock Index Fund ETF. And we can see that over the last 1 year, they haven't had a good performance at all, down by 16.5%. And if we go to 5 years, you can see a similar picture, down by 15%. And if we max it out here, what we can see is that from the peak up here in February 2021, the emerging markets have pretty much been in a bear market for the longest period of time, nearly ever. And then if we have a look at Vanguard's 500 Index Fund ETF, so VOO, VOO, very, very popular one, we can see that over the last 1 year, the US market too has been down, but by not nearly as much, so down by 7%. And then over the last 5 years, completely different picture than what we've just seen. They are up by nearly 50%. So you may be wondering, why has this actually happened? Why have the emerging markets been underperforming the US market? Well, actually, there are a few different reasons. So I'm just going to run through them quickly, and then we're going to discuss how that could change in the future and why the emerging markets actually may be a good bet for your investment portfolio. The first reason is due to China's economic growth decline, and this is because of their zero COVID policy and all of their lockdowns. Alongside this, they've had a regulatory crackdown on the big tech, and they've seen a property market crash. China is also a massive trading partner with all of the other emerging market countries. So whatever the situation in China is, that really impacts the emerging markets as a whole. Because like I was saying to you earlier, China is the largest emerging market country. On top of China's situation, you've also got the war and the oil price surge. You've got the general high global inflation, and you've got a strong US dollar, which usually negatively impacts the emerging markets because it impacts debt and it impacts trade and import. With all this said, when it comes to investing, we really must look to the future. The investments that we're making today, we're not betting on what's happened in the past. We're betting on what we believe is going to happen in the future. And when you invest in something today, what you're saying is you believe the value of that stock, that commodity, that ETF, whatever it is going to be more valuable in future years than it currently is. So, are the emerging markets going to be worth more in the future than they are today? Well, lots of experts and institutions seem to think so. In a recent video I actually made on the channel, which was all about Vanguard's market outlook and economic predictions, they've actually said that they believe the emerging markets will outperform the US stock market. And also, I've been seeing more and more of you guys in the comments saying how you're shifting your portfolios and you're more and more interested in the emerging markets in the future years. So all of that together paints a picture of just people becoming more interested in actually putting their money into a different type of investment than maybe they have before, that being emerging market individual stocks or the emerging markets as a collective, perhaps through an index fund or an ETF. So we have to think why. Why are predictions being made that the emerging markets are going to do so well? Again, there are a few reasons. Firstly, falling inflation. This graph here shows inflation across different emerging market countries, and the shaded grey area here on the right is the predicted. But this graph was made in November 2022, so some of this grey area would have actually taken place now. So you could perhaps look back and see if these predictions were correct. But what I just want to point out here is that the prediction is that the inflation in all of these emerging markets would have peaked and will now be on a decline. The next point is the full reopening of China. Remember, China accounts for over 30% of all the emerging markets, and it has really strong ties to all the other emerging market countries, like I was telling you about earlier. So this means China really is quite powerful and has the ability to pull all the emerging markets into a higher state of economic growth. And China reopening will also help ease the pain in terms of the tech sector and the real estate sector. With this said, predictions are being made that China's economic growth is going to be 5%. 5% in 2023. The next point is that the developing countries just have more potential in terms of growth. For example, they have the ability to adopt more tech and more fintech specifically, which will of course lead to higher growth than perhaps the developed world, who already has a lot of these things in play, have the possibility for. The next point is that the US dollar's strength is set to decline a little bit. As the dollar potentially starts to weaken, emerging markets could benefit from relative appreciation of their own currency. For example, the Chinese currency has already strengthened against the US dollar this year so far. I've also seen people say that the US stock market is now overpriced and over-owned. Now, of course, make your own mind up as to whether you actually agree or disagree with this statement and allow maybe that to impact your investments on your own, do your own research. But the whole idea here is that the forward price to earnings ratio of the S&P 500 index now sits at around 19. Whereas for the emerging market index, it's a bit lower at 11.5. Of course, indicating that the emerging markets may be a cheaper investment that is then expected to rise. So to be truly transparent with you where I am with this right now in terms of my own investment portfolio, well, I'm not really making any massive moves. I do have exposure to the emerging markets through my FTSE Global All Cap Index Fund, but I'm not necessarily going to add more. I may add exposure to an emerging markets ETF, but I'm going to continue investing into the US stock market and my UK individual dividend paying stocks as well. However, I do agree that there is potential and opportunity in the emerging markets, and I think it's especially true that it will be these countries that have the adoption of new tech and fintech and all things like that that will really help them to grow. So I have some questions to you, but before I ask you them, just two quick things. One, I have a Patreon, which comes with a Discord. So if you want to chat to me every day and all the other Discord members, I'll leave a link in the description. And number two, I have a very cool t-shirt. It says Eat, Sleep, Invest, Repeat, which is a great psychological reminder to do all of those things every single day, or at least regularly. So I'll also leave a link in the description to those t-shirts as well. They come in 6 different colors, so have your pick. Back to the questions that I have for you. The first one is, do you see the US economy slowing down in the future years? And the next one is, do you see the emerging markets as the next best area for investors? And if you do, are you then adapting your investment style to fit in with this? Thank you so much for watching, and I'll see you in another video.